Ever pondered what a yield curve is and how it can predict economic trends? Well, let's unravel this mystery. Picture a graph. On this graph, we plot the interest rates of bonds of the same credit quality, but with different maturities. This, my friends, is the yield curve. Now there are two common types of yield curves that you'll often hear about: the upward sloping or normal yield curve, and the inverted yield curve. The upward sloping yield curve is a sign of economic growth. Here, long-term securities have a higher yield, as investors demand a premium for tying up their money for a longer period. On the flip side, we have the inverted yield curve. This is where things get interesting. When short-term securities have a higher yield, it often indicates that a recession may be on the horizon. Why? Because investors are anticipating lower interest rates in the future as the economy slows down. So the yield curve can be a crucial tool in predicting economic shifts. And understanding this can give you a head start in navigating the financial seas. Now, how does this yield curve hint at an impending recession? Let's take a brief journey through history. Traditionally, an inverted yield curve has often been a reliable predictor of an approaching recession. This inversion happens when investors, anticipating lower interest rates in the future, perhaps due to a slowing economy, start demanding higher yields for shorter-term bonds than for longer-term ones. So, what's the story today? Our current yield curve is indeed inverted. This suggests that the market is bracing for a potential slowdown in economic activity. But remember, the yield curve is just one tool among many, and it's not a crystal ball. It's merely showing us what the market expects, not what will definitely happen. There's also an interesting pattern to note. In many instances, a recession has followed not immediately after the yield curve inverts, but after it reverts back to being upward sloping. This could be because by the time the market's expectations shift and the curve normalizes, the economic gears may have already been set in motion for a slowdown. So, an inverted yield curve could be the harbinger of a recession, but what does this mean for investors? A recession spells doom and gloom, right? Not necessarily for the savvy investor. Let's take a detour from the traditional perspective. Recessions, while challenging, can indeed present unique investment opportunities. How, you might ask? Well, it all comes down to the basic principle of economics: supply and demand. During a recession, asset prices typically drop as demand decreases and supply increases. This dip in prices provides a window of opportunity for investors to buy assets at a lower price than they would under normal economic conditions. Now, imagine the economy starts to recover. As it does, the value of these assets begins to appreciate, giving rise to potential profits. This is where the magic happens. Those who had the foresight to invest during the downturn now stand to reap significant benefits. It's essentially a game of patience and strategy, waiting out the storm to enjoy the sunshine that follows. The key is to remain vigilant, understand market trends, and most importantly, not to panic. So, while a looming recession might be cause for concern, astute investors see it as a golden opportunity to buy low and sell high.